For some investment insight now, we cross to Cape Town, where Rashaad Tayob, portfolio manager at Aeon Investment Management, is standing by. Rashaad, thanks so much for joining us this afternoon. Well, we're well into our way on 2012. We've had some commentary emerge that it's time to be getting a little bit more optimistic on the markets. What's your perspective on the current investment environment?
Yes, I mean, 2012, it's been a good 2-week start to the year. We've seen equity prices rise, bond yields fall. The rand has strengthened quite a bit. So there is a lot of optimism in the market, and I think people are hoping that we've passed the gloom of the last couple of years has passed us by. However, we remain particularly cautious. The debt at both the consumer and the government level, at the government level, is going to continue to weigh on the markets and weigh on sentiment going forward. In the last few years, there's been a lot of movement in terms of deleveraging in the private sector, the banking sector, but we still haven't even touched the surface of containing government deficits. And you know, with major countries, the US and the UK, running something like 10% deficits, the social problems you've seen, without them even having to scale that back, once they start scaling that back, you're going to see the effect on that. And we don't think it's going to be as easy as what the markets are maybe thinking at the moment.
In that context then, take us through your asset allocation at the start of this new year, Rashaad, and we're looking specifically here on the local front.
On the local front, I mean, there's two funds we manage. It's the Absolute Fund, which has a protected equity exposure. It has a minimum return of 0 and tries to capture as much of the market upside as possible. Over there, we remain neutral. We have a neutral exposure of around 50% equities, but that's fully protected. Given the risks I've explained, you could ask, why are we not lower in equities? Why are we not taking a very pessimistic approach? And the reason for that is because valuations are reasonable, and over time, the main downside risk that investors face are not necessarily the macro risk, but rather the risk of buying overpriced assets. Yeah. So we have a neutral exposure to equities of around 50%. We've upped our inflation-linked bond exposure from around 10 to 20%. We see value in that asset class. And then we have a component of preference shares, a component of property. So just generally neutral exposure across, but very positive in terms of inflation-linked bonds.
A key to your investment strategy, I guess, and important to stress here, is that it's not that you have any preference for specific asset classes. What forms the basis for your preference right now, or at any specific time for that matter, is the value that they offer, and the success of that strategy actually comes moving in and out of these classes as they offer that value.
Yes, I mean, that's precisely it. The fixed income fund, the diversified income fund, it had a good year last year, outperforming the benchmark by a significant margin. But that's not just because of, say, bonds, inflation-linked bonds, our preference share exposure, but rather the combination of buying those assets when they offer value. So we use a range of asset classes, and we're very much driven by the valuation and the potential upside and downside of the asset class at any specific time. And at the moment, given where real yields are around 2.5%, the inflation outlook, 6%, with the risk that it could be higher, we think inflation-linked bonds are what is going to deliver value over the next 12 months. So and that's why we positioned quite aggressively in that asset class.
So it's premised on the fact that inflation is going to be coming through more strongly, and where it presents a risk to nominal bonds, you're stripping out some of that risk, and you're taking advantage of yields, but taking that inflation risk out of the picture and out of the equation.
Yes, precisely. South African bonds are very attractive in international context. So if you look at our 10-year yield, around 8%, UK, US, Germany yields around 2%. So you've got a 6% spread on bonds, which is around the highest it's been for the last 10 years. Countering that effect, so we like South African bonds on a relative value basis. What we're seeing, though, is the fact that inflation has been rising, and the market is not quite accounting for the fact that it can remain higher for longer than what we've previously anticipated. So we had a very positive inflation period in the mid 2000s. We then had inflationary pressure rising, but with the rand strengthening all the way, towards 650. That inflationary pressure was mitigated. So a lot of with goods prices falling, with us importing deflation, inflation wasn't given the opportunity to rise. We think now that the rand has retraced back to fair value, a lot of the inflationary pressure that was latent is going to start to build up in terms of, we know that food and transport has been rising, but in terms of clothing, in terms of furniture, all those things which were weighed down by the strengthening rand are going to start to come through, and you could see inflation coming towards 7% by the middle of next year.
You've just touched on there that you see the rand at current levels at fair value. What's your outlook for the local unit moving forward?
I mean, for us, when we look at assets, we like to take positions when assets are away from fair value. So if they're above fair value, we sell them. If they're below fair value, we like to buy them. And we did hold an exposure to offshore cash, so being negative on the currency when it was at low levels, and that provided us with somewhat of a hedge against the market falling last year. However, given that the rand has moved back to fair value, we've on the diversified income fund, we've closed that positions out, and our neutral exposure is zero. And that's specifically because the fund has a cash benchmark. So we look at assets when they have the ability to deliver outperformance relative to cash. And when an asset like offshore cash is at fair value, then we'll remain neutral. We'll have zero exposure.
So on the equities side of things, you've hedged fully to protect the downside. You've got pretty conservative exposure there. You've got an allocation, you alluded to a little earlier, to preference shares as well. Take us through your exposure there and how investors should be playing in this space, because there has to be caution against it running hard and that potential. And investors have got to be cognizant of the yield and the risk that it presents.
Yes, I mean, I've been actively involved in preference shares for many years, and around 2004, 2005, when they launched in the SA market, there was quite a bit of hubris around the asset class. So people looked at this tax-free yield and they thought this is the greatest asset class ever, and it's going to be the cure. We need to have huge exposure to this. And if you look at how the asset class performed, it rose around over 20% and compressed the yield that you got. So where you previously got a yield spread above, say, cash, a tax-free yield spread of cash around 2%, that spread all the way, compressed all the way to zero, which means that it wasn't really compensating you for the risks you're getting. At the moment, it's offering a 1% yield spread above cash, but tax-free, so there is some value, and they have performed in the last couple of months because of that value. We held the big four banks pref shares. We find them attractive even at these levels. And we're very happy with the capital adequacy of the banks, of the big four banks in South Africa. We also held the Discovery Pref when that launched. That performed very well. It's gone up about 8%, provided you around a 10% return. But we've sold that out recently because we think that the yield spread has compressed too much. So the investors should look at it, but focus on what yield pickup you're getting. And when that yield pickup gets too low, then you need to look at divesting out of that again.
Another area you've divested out of and reduced your exposure to is property and the exposure there. Take us through why you're reducing that exposure right now, because it's got to be telling about your economic outlook for the South African economy.
Yes, I mean, the diversified income has a cash benchmark. So every time we're looking in asset class, we're looking at what's the upside and downside relative to cash. And we've reduced property from around 7% all the way to 3%, primarily because of the outlook for the economy, the fact that property yields are very low relative to bond yields, so on a relative value basis, and the fact that distributions in property have fallen from the 10% to even up to 15% that investors have gotten used to. They've fallen towards 5%, and in my opinion, they can actually be flat this year. So with flat distributions, with a yield less than bonds, we're not seeing enough upside in this asset class over the course of this year. So we've reduced that exposure, and it will continue to reduce that if the yield continues to fall.